Hello there everyone, today's video I want to talk about a bit of double taxation resulting from the recent budget surrounding inheritance tax and pensions and also income tax. So I'm not sure many people have grasped this situation yet, but I just wanted to highlight it to you, and then in subsequent videos we'll talk about some planning. But let's just have a look at what this means, these recent changes to inherited pensions. So let's say you've got a guy, Mr. X. He's divorced. He's not got any transferable nil rate bands to his wife. There's no wife in the picture, and he has a grown up child, and he dies at the age of 76. He's got $500,000 in his pension pot. He's got $500,000. So the rules before the budget of a few weeks ago said this, that basically that 500 grand would transfer to his nominee, the beneficiary, in his will at the pension fund. It goes off to his adult son. Okay, so the adult son gets the pension pot, $500,000, no inheritance tax. So that was the rule until the 30th of October, no inheritance tax. So this guy inherits it tax-free of IHT. But then the son says, you know what? Actually, there's a nice buy-to-let or a couple of buy-to-lets I want to buy. I think I'll use dad's pension money and I'll go and do that. So for this son to acquire the $500,000 pension pot, he's got to pay income tax now to get his hands on it. So it hasn't suffered inheritance tax, but the son, to get his hands on it as a cash lump sum in one go, he's got to pay income tax. So let's assume he's a high rate taxpayer, 45%. So he pays 225 grand on that $500,000 pension pot. So in his back pocket, son will have 275,000 to go and buy his buy-to-let. Okay, so dad dies, $500,000. Son ends up with 275 grand. So that was the situation before the 30th of October. What has happened since then? Well, what they announced on the budget is that the IHT free bit goes. In other words, there will be inheritance tax on inherited pension pots. But what hasn't changed is this whole income tax thing suffered by the beneficiaries. So now you've got double taxation. You've got inheritance tax followed by income tax. So let's have a look at an example. Same situation. Mr. X dies, but he dies on the 1st of November 2024. Actually, sorry, that's a bad example. It's because this kicks in 2 years' time. You always got to be mindful of the budget pronouncements. Some of them kick in midnight of the budget, some from the next tax year. This one's coming in 2027. All right, let's fast forward and assume this guy dies in 2028 and the new rules are in force. What happens? Well, that 500 grand that was in his pension, his son doesn't get it free of inheritance tax. The pension providers are obliged, or will be obliged, to pay the inheritance tax. Now, inheritance tax at the main rate is 40%. And again, assume this guy's got other assets, that he's got no nil rate band left. So he's got 40% on $500,000 of pension. The pension fund provider has got to pay that over to HMRC. That's what they're saying will happen in terms of the mechanics of this thing when the rule kicks in. So pension fund has paid 40% to HMRC. And then the money, the balance, then goes to the son. So the son has got 300,000. What does he do? He takes that as a cash lump sum in one go. But then the rules on that bit haven't changed, and that is subject to income tax at his highest marginal rate. We've already said he's a 45% taxpayer. So he pays tax of 45% on the 300 grand post-inheritance tax received from his dad's pension. He ends up in his back pocket with 165,000. So there's been 200 grand inheritance tax being paid to HMRC, and then the son pays 135,000 income tax to HMRC, ends up with 165 grand in his back pocket. Now, considering what would have happened before the budget, he'd have ended up with 275 grand, plays 165 grand. So £110,000 worse off because of the budget pronouncements and due to this double taxation. So when you look at the effective tax rates, come back to scenario A. If the father had died before the budget, what's the maximum, the tax rate? Well, he ends up with 275 grand and there was $500,000, that's 45%. Well, that's, yeah, we know that because it's easy to work out because it's 0 IHT, 45% income tax, effective rate 45. Now, he's ended up with 165,000 out of the $500,000. That's an effective tax rate of 67%. 67% tax, the impact of double tax in quick succession. Now, what you might say, well, what can we do about it? Well, here's the thing. So, this is going to come in, this inheritance tax on pension, that's going to come in. But what about the next bit in terms of what do you do with the inherited money after inheritance tax has been paid by the pension provider? Well, actually, there are certain things you can do. You do not have to take it as a cash lump sum in one go. I just did that to illustrate the maths and to show you the effective rate and the double tax. You don't have to. You could leave it invested and then draw an income from it down the line in the future. So in other words, this son could say, look, I don't need this money for the buy-to-let. I'm doing quite well, thank you very much. I will take the pension money, but leave it invested, and I'll draw an income from it when I retire. At which point, I won't be a 45% taxpayer, I'll be a 20% taxpayer. And so I'll take the income then. That's great. That's going to save a few quid long-term in tax. The problem is this, and this is the practical thing I want to get across. A lot of pension providers, these guys, yes, they've paid off the IHT in a few years' time, like they're going to be obliged to. They don't give the beneficiaries the choice. The government say, oh, you've got a choice of what you can do. You can take it as a lump sum, you can invest it, you can draw down on it, whatever you want to do. But it's all about the pension provider. Because if the government say, yes, you can do that, practically, it's all about, will the pension providers facilitate that? And a lot of them, I'm hearing a lot of them will insist that, in this case, the son, the beneficiaries, just take it as one lump sum. You've got no choice but to have it as one lump sum. Oh, and then therefore you're going to be clobbered for 45% tax. So start to think about what type of pension arrangements you've got. Is there any, if inheritance, is obviously an important thing in pension pots, particularly given the fact that since pension freedom came in 10 years ago, a lot of people have put money in who didn't really need the pensions. I'm talking about company directors to get corporation tax, various other tax breaks, tax-free growth, on the proviso that it was going to pass tax-free to the next generation. All of a sudden, that's gone out the window. So, what can you do about it if you don't want the offspring to get clobbered for 45% because that particular pension fund doesn't give them the option of doing some of the other things? So you need to have a look at the type of pension you've got. Can it facilitate that? Because, of course, moving from one pension to another whilst you're still alive, so one pension that hasn't got that flexibility to another pension that does allow drawdown for the beneficiaries, that is a non-taxable event in lifetime. So you can move pension pots around while you're still alive, no tax implications. Yes, there might be certain other admin hassles and everything else, but it shouldn't be that onerous because it happens all the time. People move pension pots around. So just something to think about. Have a look. Will the offspring be clobbered for 45% tax in one go after you die in your pension fund? Or is there something you can do now to move your pension pot somewhere else to a pension provider that's more flexible, that will facilitate, for example, the post-IHT proceeds to be kept invested, and then the beneficiaries can take them as income down the line. So just something to think about there. Double taxation on inherited pension pots, inheritance tax, income tax, not great. And you need to be wary of that, and also the type of pension that you've got to try and mitigate some of this double tax on the back end on the second bit of the double tax, on the IHT, what can we do to get it below that 45% if it's a big lump sum? So, yeah, overview there. Inherited pension pots, new rules coming in from 2027. If you like this video, please do subscribe. And as always, I'll see you soon.